Welcome to Private Banking for Individuals. This is one of our master classes in our Debt Management Solutions series. I will be your host, Scott Shelley. I am the CEO of Apollo Risk Management and the creator of the Protect and Prosper portal. Within this masterclass, we will be looking at the massive amount of financial losses incurred by everyday Americans as they finance their way through life, and explore exactly how to avoid and eliminate interest losses and incorporate a strategy to build wealth rather than lose it with our capital purchases. Before we get into the module, our key lesson number 1 is that wealth grows far greater when you're not losing it. Most Americans will lose hundreds of thousands in interest losses over a lifetime, hundreds of thousands on houses. A home purchased in 2024 with a 30-year mortgage will cost more in interest than the purchase price. The average person will lose $20,000 to $30,000 on every vehicle they purchase. The average family will suffer six-figure losses every 5 to 6 years just on auto purchases alone. And the average student taking out a loan will pay 150 to 200% more for that education than what it originally cost. It wasn't a $40,000 education, it was a $71,000 education. Americans are burning wealth financing life. What if you could recapture those interest losses and build wealth for your family instead? When would you like to learn how? How about now? Private banking is a strategy of owning the bank in order to minimize interest losses and maximize family wealth. This strategy goes back over 100 years in America and was used by the Rockefeller family to grow their empire coming out of the Depression. Some of the greatest American businesses used private banking to launch their fortunes, like Walt Disney and Ray Kroc. Entrepreneurs like my wife and I have used our private bank and line of credit to acquire and renovate an Airbnb, and we are currently using our line of credit to develop and launch a global crowdfunding app to support mountain bike trail maintenance, something we are deeply passionate about. So why did Walt, Ray, Tara, and Scott all use private banking? To avoid and recapture lost interest expenses, to provide asset protection on personal assets and business projects, to control your cost of borrowing indefinitely, and to control all loan repayment terms, to build a deferred tax-exempt retirement fund you can tap into later, and to fully asset protect your capital from all creditors and markets. Key lesson number 2, banks make money, big money. When you own the bank, you make the big money. So let's take a look at what we're talking about. Here we have a $55,000 truck purchased, financed through Bank of America. And we see that the car purchaser paid $911 a month for 72 months for a total interest of $10,628, giving the bank a 19.2% profit on that loan. So at the end of 6 years, the truck owner has a $30,000 truck they paid $65,600 for, taking a 65% capital loss, while the bank made 19.2% profit. Sounds like an awesome deal for the bank. Private banking is the strategy of using a controlled line of credit off a protected capital account to personally capture the interest on purchases while simultaneously providing tax-exempt growth on the capital reserve. When you become the private bank, that $10,600 interest, that 19.2% profit is your profit. And that $55,000 capital that you used to acquire the vehicle, that's your capital. That capital has been compounding for 6 years while you paid yourself back. And so at the end of 6 years, rather than having a 65% loss and a $30,000 truck, you have a $30,000 truck and an $89,000 capital account of which you can use to go acquire more assets. And so private banking is a strategy of funding working capital into an account that complies with the IRS and Internal Revenue Code 7702. This is what gives it its asset protection and tax-exempt status. This working capital is then used to finance your vehicles, your college, your business, your real estate, and grow that capital account over the next 5, 10, 15, 20, 30 years so that you can, at retirement, live off of that capital account in a tax-free fashion. Any capital you put into the account becomes tax-exempt indefinitely. You have a guaranteed line of credit on the cash value indefinitely. Most contracts will give you a guaranteed 5% interest cap on loans, so you can control your cost of borrowing and maximize the amount of interest that you're recapturing with your purchases. Contract owners dictate all the repayment terms, and historically, the capital in the account is going to grow at somewhere in the range of 6 to 8% internally, while you're using the capital externally in your life and your business. All of the capital in the account is fully asset protected from creditors and payable directly to your named beneficiaries upon your death. This is the exact strategy employed by some of the biggest banks and financial institutions on Wall Street. And we can see that the largest banks have massive amounts of capital deployed into these BOLI or insurance contracts. And the reason is for not only their tax-exempt status, but their safety of capital. It is a Tier 1 capital asset. A Tier 1 capital asset that outperforms Treasury with absolutely no drawdown risk to the bank. This is why they like so much of their capital in these contracts. So let's expand on why private banking is so important. In this example, we have $100,000 with no lending. It's just going to organically grow in the market at 7.5%. And so $100,000 over 20 years at 7.5% will give you about $425,000 available for retirement. However, if you had that same $100,000 of capital and you deployed a private banking strategy using private lending, you now have the opportunity to take the same $100,000 over that 20 years and potentially grow it to over $1.6 million for retirement. Would you rather go into retirement with $425,000 or over $1.6 million? Would you rather the banks get rich or you and your family get rich? Remember, wealth grows far greater when you're not losing it. Because what you do today and how you manage your money over the next 10 to 20 years will determine exactly how you live tomorrow. The power of uninterrupted tax-free compounding is undeniable. A 50-year-old with $250,000 can start private banking and potentially grow that into over $2 million for retirement. That $2 million continuing to grow uninterrupted and tax-free would provide them with $10 to $12 million in retirement spending capacity. This is nothing magical. It is simply math over time. A 45-year-old funding $25,000 a year for 10 years, building a $250,000 line of credit, could expect to draw out $40,000 to $60,000 a year of tax-free income depending on how much lending they did. A 50-year-old funding $200,000 over 5 years to build $1 million line of credit could generate $200,000 to $270,000 at retirement, tax-free, depending on the amount of lending they did. If you would like to incorporate a private banking strategy into your life and start building wealth for retirement rather than losses, complete the worksheet linked in the portal, and our team will go about building the plan. This completes our private banking module. We hope you enjoyed the content. Schedule a call with our team today to discuss your private banking strategy.